The new gold rush is all about vaults, about the vaults being built in Europe to accommodate all the people who are buying gold.
Sprott Asset Management and a fund managed directly by Rick Rule have recently come into this tiny zinc company to become their largest shareholder. Since their recent drill results, Sprott has joined other large institutions like Euro Pacific Gold, Resource Capital Funds, and the Commodity Discovery Fund. To learn more about this incredible opportunity in the resource sector, visit crushthestreet.com/zinc.
crushthestreet.com. I'm Kenneth Amaduri, and I'm joined today with a past guest, returning guest, Trader Stef on crushthestreet.com. And she's given us some great analysis on precious metals, what's going on in the economy, and gold is, yes, stealthily moving higher. We hit $1,300, and in case anyone isn't following in it and is distracted with Bitcoin, gold is moving up. And one of the things I've said is that we could very well see it move up into the $1,400, $1,500 range before people even start paying attention to it. And we have some Johnny-come-latelys. But Trader Stef, now a contributing editor here at crushthestreet.com. If you want to see some of her latest posts, visit crushthestreet.com, click on her name. Her Twitter handle is @TraderStef. Steph, we got a lot to talk about today. Thanks for coming on the line with me.
Hey, thank you for having me. Yeah, we got a bit to talk about. Let's roll. Looking forward to it.
We haven't talked about Trump in a while, and I must say we should talk about him now here for a minute. The climate accord was very much something that I think many of us voted for. It was election Trump, election campaigning Trump. I think many of us were worried that he was losing track, or at least losing control of the Republican Party, because they seem so fractured. And you've compared Trump to Andrew Jackson. Interestingly, Jackson, the founder of the Democrat Party, and not looked upon too greatly considering his leadership in the Trail of Tears for Indians. But just some initial thoughts on Trump and your comparison here to Andrew Jackson.
Yeah, I've hashtag Trump the Jacksonian, so folks can find that on Twitter. I think I want to keep that thread running for a bit as things mature with his presidency. There are some points about Jackson. I got a list of, I got 7 that remind me of Trump. And even this morning, he's out there twitting away, and he says the fake mainstream media is working so hard trying to get me not to use social media. They hate that I can get the honest and unfiltered message out there. Hey, now I bet you some folks have also seen that, lots of cartoons about this. There's one with him flying on the little Twitter symbol, crapping on the mainstream media guy with the microphone. That's what I think about. But he's so Jackson, and let me point out why I think he is. Andrew Jackson, one of his goals was to clean up corruption, right? And he got rid of a lot of people. It was really about only 10% of the cabinet and some officers. And Trump's got the saying, drain the swamp. So that's this underlying theme going on. Number 2, as you mentioned, Trail of Tears. And that can be misunderstood. It's not such a great thing, but if you compare it to extreme vetting, what's going on right now in the travel ban, well, recall, you got to put yourself back in that century with Andrew Jackson. And the thing with the Native Americans is that his concern was that they were not assimilating with the quote-unquote white culture, and he wanted to move them to the West. So, I don't want to get into all those details. It worked out in some respects, but in other respects it didn't. They were here first, and they got pushed out. And the Trail of Tears was really awful. But the reasoning for it is similar to Trump with the extreme vetting and what's going on in the world. Hey, look at the terrorist attack over the weekend. It's just unbelievable.
Except for the fact that those that are coming and that we're vetting weren't here first. They're wanting to come.
Yeah, and even in those cases, even if their parents came and they were born and they were natural born citizens, they can be radicalized as well. So It's a real tough call, but you got to do something. You have to start somewhere. You have to do something, and he's getting a lot of flack for that. So hey, I'm glad I'm not the president. I couldn't do what he's doing. He's a penny pincher, just like Jackson. He wanted to fix the budget, and Trump wants to run the government like a business. And keep in mind, Jackson was the only president that paid off the national debt and left office with the country in the black. The only one. Clinton never did that, despite some theories out there. He wanted to fix troubles with the bank. Trump really hasn't gotten to that, but he's beginning to show some interest in doing something. He does things in a very controlled manner. It's like he's got a plan, and the way he does things is not necessarily agreed with, but in the end he gets the same results. There's also Jackson felt that he was a true representative of the people. Now, Jackson was a general, and he ran the battle down in New Orleans, and it was a surprise win because he ran out the British. And that really got the people behind him, and that's how he ended up in the White House. So his relationship with, quote unquote, the people through his first term was why he did what he did. And Jackson believed that he had to use his office to carry out the people's will. And now Trump, he ran on "We the people," and I'm doing this for you. So there was even an article that came out in AP called the Jacksonian Revolt, which talks about those themes. Two more points real quick. There's a magazine called Foreign Affairs, which is run by the CFR. And they put an article out, which they're usually critical of Trump, but this was for him on Foreign Affairs, and that was something I mentioned. The article just came out recently, but in my last interview I mentioned that I trusted Trump because I felt he was going to put the right people with the skills necessary in the positions where it can be applied. And the Foreign Affairs magazine put out an article talking about that most recently, that's what he's doing. And lastly, Jackson wanted to reform the currency. And Trump has a lot of advisors who are along those lines, and one prominent one is Dr. Judy Shelton. And she's actually, I'll give you a quote. She says, "In terms of gold being involved, some people may think that as a throwback, but I see it as a sophisticated, forward-looking approach because gold is neutral and universal. It's well accepted and transcends borders and time. If you look at the foreign reserves of most countries, they keep it mostly in gold." And she says, "I don't want to read too much into it, but it proves that gold is not some barbaric relic." So she's thinking about another Brent Woods, and she ain't got no problem if it happens at Mar-a-Lago.
Well, we know every 40 years, at least back for the last while, we've had a new monetary system. So we're definitely due if history is going to at least rhyme. Steph, the Fed yet again decided not to raise rates. And, talking about the markets here, the Shiller PE ratios, we've only seen valuations in the markets this high two other times. Once in the 1920s prior to the crash, and in the 1990s prior to the early 2000s crash. And one of the things you've pointed out in previous Crush articles is low unemployment numbers are probably not a meaningful indicator for higher inflation, therefore keeping interest rates the same. Let's get some thoughts as to where we are and what the Fed is thinking.
It's still the great paper caper, It's all the data's bad. Nothing's changed. They're hiking rates into weakness. That's pretty much obvious to anyone that's following this. First quarter 2007 GDP came in at 7.7. It was revised up to 1.2. That's still really bad. Retail, we got ghost malls, we got bankruptcies. 70% of GDP is driven by consumers, but look, online buying only consists of 8 to 9% of that. So online is not closing down brick and mortar by a long shot at this point. You got housing slowing. We have unaffordability back to the bubble peak with no meaningful increase in wages. We have a renter nation. We had a boom in multifamily unit construction. And now the higher end markets are beginning to show stress. And the lack of inventory can be attributed to actually unaffordability. So some of those high-end markets, Greenwich, Connecticut, where a lot of the financial mavens live, they can't sell their houses, Miami, Florida condos, New York City apartments and condos, and the San Francisco and California well-to-dos. Sound familiar? 2007, 2008. PCE core inflation, it's again below our 2% target. So it's not really bumping up above that line. The jobs numbers, like you mentioned, they're horrible. Look, 93% of new jobs since 2008 were added through the birth-death model. You know, what else you need to say about that? Real wages continue to decline. Manufacturing's not looking too hot. New orders tumbled in May, and that hit the U.S. dollar. Auto inventory is building up, with subprime auto loan delinquencies near the Great Recession peak of 4.7. Consumer credit is heading down a drain. The services sector is slowing down. Corporate revenues are plunging. Business debt to GDP is at an all-time peak, more than it was back in the big crisis, the Great Recession, and they're more leveraged in business than they were in 2008 as well. And the velocity of money is still crashing. We're down in the 1940s and 1950 level. And now we've got some of the Fed folks coming out and jawboning. They're jawboning possible paper caper. They're going to stop raising rates. Well, Brainerd started this back in January, and she was raising the red flag on unemployment numbers and core inflation. And then Bullard came out. I wrote a piece about him, and he put this presentation up, these slides, and the last one was his conclusion. And he says, this was last month, if I'm not mistaken, on balance, the U.S. macroeconomic data has been relatively weak. U.S. inflation and expectations are surprised to the downside. Labor market improvement has slowed over the last 2 years, and low unemployment readings are probably not an indicator of a meaningful higher inflation over the forecast horizon. So how did he feel about the market doing the complete opposite in March when they raised a piker of 0.25? He says, this may suggest the FOMC contemplated a policy rate path that is overly aggressive. And then we got Fed's Powell, and he had an Osh moment. And Luke Groman on Twitter, he made a very interesting observation. He said, translation, Osh, the world continues to de-dollarize. The dollar is below 97, and U.S. economic data is weakening, and the curve is flattening. So then we've got balance sheet reduction. They're going to reduce the balance sheet. All right, no, it's total taper caper. Listen, this is what they're talking about doing. They're going to do it at a snail's pace, and they're not talking about selling the bonds or even letting them expire and run off. They're talking about slowing the pace of the reinvestment. So instead of buying new ones with 100% of the old ones, they're just going to reinvest maybe 90%. That's not really going to open up any significant stimulus. And Adam Button over on Forex Live had that to say. So I totally agree with him. And then we got interest rates. Hey, the yield curve is not quite inverted, but it's beginning to. And I got a couple of charts. And if we look at them and we take July 2015 and compare it to today, we can see how nominal interest rates and real interest rates compare and what that slope is. So over at the far left, you got the 1 month interest rates, and over on the far right, you got the 30 years. And the long terms are higher than the short term. And then if we go look in history, and let's look at March 2007 and compare it to today. And you can see how back in 2007, the low end was a lot higher and the long-term bonds were lower. That's an inverted yield curve. And every time we get one of those, we go into recession. So are we going to get there? It's hard to say. But look, Trump is considering bringing in, he's got to fill a couple of Federal Reserve seats. And one of those folks is Marvin Goodfriend. And this guy loves NIRP, negative interest rate policy. And Jim Rickards actually brought up a chart on Twitter, and I got that image too. And the 5-year inflation-linked Treasury tips yield is negative again. And gold really likes that. And lastly, I'll say Lacey Hunt. You know, he nailed it. He gave a great interview. If you want to play that clip, What he says is really important, and he lays out everything for the common man to understand.
Then they instituted quantitative easing, which I think has only produced the most marginal of positive benefit. But it has also created a lot of negatives. One of the most glaring is that this liquidity has fueled record leverage of the business balance sheet. And we're more leveraged in the business sector than we were in 2008 or 2009 or any other time in our history. And I think that what the Federal Reserve did is they said to the world that we're undertaking quantitative easing so that we can boost the stock market. And the stock market will then produce a wealth effect, and this will invigorate the economy. Well, the wealth effect, which is a big item in the Federal Reserve's econometric model, is in fact not empirically observable. Mm-hmm. And this is the worst expansion in U.S. economic history going back to 1790. By far the worst expansion since the end of World War II. And we've had a very strong stock market. There's not enough ownership by enough people for the stock market to benefit. However, when Bernanke and then later Mrs. Yellen said that their objective was to boost the stock market, it was a sign to the business executives to emphasize financial investments over real investments. The Fed's backing your play, and you can engage in financial engineering, buying back your shares, buying the shares of others, raising dividends, other financial transactions. The business managers think that they can reverse those, that the liquidity will be there.
Right.
You install a set of new plants and production lines and so forth. If the demand doesn't materialize, you're stuck with it. You're not going to be able to liquidate it. And so, in essence, what the Federal Reserve mistakenly did is that they encouraged a shift from real investment into financial investment. Last year, business debt increased by more than $700 billion. And business debt to GDP set a new all-time peak, but investment in plant, equipment, and inventories fell by over 20 billion. And it's the investment, the real investment, which grows the economy. And so the Federal Reserve has, in fact, by this unprecedented program, created very significant unintended consequences, which have undermined the U.S.'s capability to grow, to have gains in productivity, and to lift the standard of living.
So they're going to hike rates twice, they say, in the next.
They say that.
They say that. It's going to happen?
For me, that whether they do that or not is immaterial, because already the Federal Reserve policy is biting. And raising the short-term interest rates just a small amount and to a still low level of less than 1% on average. The Federal Reserve has already engineered a contraction in the reserve aggregates. The rate of growth in the money supply is declining. Bank lending has dropped even more precipitously. All major categories of bank lending are slowing, from business loans to consumer loans to real estate. And the rate of decline in velocity has increased, which means that monetary policy is intensifying. So if the Fed goes through, raise the rates another 2 times, what they will do is they will shift the supply of credit curve inward, cut the downward sloping demand for credit, raise the rate. This will put more downward pressure on the monetary and credit aggregates. And one of the things that I talked about was that since 1915, of the 18 recessions, all of them were preceded by monetary tightening. The only one where there was no monetary tightening in a recession was when we ended World War II.
Steph, you brought it up. The U.S. dollar is certainly getting weaker, and it seems like we're on a steady downtrend. And I'd like to get your thoughts on where we are with this and what are the implications?
Yeah, the U.S. dollar is breaking down. I put a chart out there. It's the weekly, and it was as of last night at 4:30 p.m. And we were sitting at 96.80. And the last time I looked today, we were sitting at 96.54. So if we go into the details of this weekly chart, take note of the trend line that goes back to May of 2014. And we started breaking down through that 3 weeks ago. And that was shortly after we broke through the 50 exponential moving average. That's that light blue line marked there, the 50 EMA. And now we're sitting on the 100 EMA. That's the green line. Now, behind all these lines and stuff, so it can be kind of confusing, I got the Fibonacci numbers. And, you know, Fibonacci is the math of the universe. And we're hitting those Fibonacci numbers. And now that we've tapped the next one down the line, it looks like we may go down to the 150 exponential moving average, which is the next level for the Fibonacci. So we're still breaking lower. The other indicators that I use, the ADX and the DMI, is very negative. It's got an alligator tongue set up. You can see down there in the bottom right where the ADX comes up underneath through the red and the green line. The red line's on the top, green line's on the bottom. It's a perfect setup. And the Stochh RSI has been negative for a while. So, you know, we may be getting close to a low here, and then we're going to pivot for a bit. It's kind of hard to say, but we got to keep a close eye on this because, you know, gold and the US dollar and or silver generally have a inverse relationship, but not always. You know, the tighter you drill down into the shorter time frames, you get some correlations where they're going in the same direction. But right now, overall, in the long term, the dollar's breaking down and gold is benefiting.
Well, that leads right into gold. Gold's notches 7-week high as safe haven demand is soaring, and it's on a stealth rise. I've said it a couple times now, and I feel like many are missing it because so many of us are focusing on Bitcoin. But I want my audience to pay attention to this because it really is something that deserves our attention. And let's get your analysis on it.
Well, we've had some interesting news articles this morning. Bloomberg's out there pumping the gold story. Look, it's all about that trend line from 2011. And we've talked about that on numerous occasions. We've run into it. We haven't been able to break through it. And then we come back to it, try it again. It doesn't happen. I'm going to put my neck out there. I think we're going to break through it this time. And we actually have at this point. We just haven't done it decisively, and that's important. We want to see it in price and volume. So back to Bloomberg, they're out there pumping the articles. China gold imports seen jumping 50% as haven demand booms. The new gold rush is all about vaults, about the vaults being built in Europe to accommodate all the people who are buying gold. Hey, look, they were talking about that like a year ago. So now the vaults are getting finished and the customers are coming in. But you got some folks out there in the business who've been in the business for a good 20, 30 years, and they're like, hey, these folks are coming out of the woodwork. We don't know where they're coming from, but we just can't meet the demand. So that's encouraging. Zero Hedge came out today with the bond yields tumbling after China said, hey, we're ready to buy more U.S. Treasuries, right? So we got demand into U.S. Treasuries, and the rates are falling again. We're pretty much not across the board on the yield curve, but we're pretty close to where we were before Trump got elected. So the Trumpflation trade, it's kind of running its course, it appears. We got Reuters coming out with investors flee to gold and German bonds as political worries rise. We got the Middle East. Hey, Qatar. Who thought of, Qatar, right? The GCC, the Gulf Cooperation Council, they've kind of said, hey, we don't want you in here anymore because you're funding the terrorists. Are you kidding me? Yeah, and apparently it's all about some hostages that they paid $1 billion for that were part of the royal family. But hey, who knows? I have no idea. But it's causing some chaos in the markets. Don't forget, the United States has a military base there, and that's where their CENTCOM operations are for the Middle East. And the Pentagon is hush-hush about that today. They're like, we have no opinion with this. We've got the British elections coming up this week. We got Comey coming in for testimony, and we got an ECB policy meeting. So there's a lot of things coming together at the same time that are affecting the gold price. So that's why I'm thinking, I think we may bust through that line pretty good this time. Before we hit that gold chart, just a little trivia. The S&P 500 year to date is up 7%. Gold as of today is actually up 12.5% year to date.
Yeah, it's really one of the most strongest performing assets of the year.
Yeah, it is.
Yeah, so let's get to that chart.
Yeah, so gold weekly. You can see the 2011 trend line, which there's something else that has popped up recently that's sitting right there with that trend line, and that's an inverse head and shoulders neckline. Inverse head and shoulders are really good indicators. They work great short term, even better long term, but they're much more accurate when you got a down sloping neckline, which is what we have here. The volumes are solid. You know, they're not out of the park, but they're much higher, comparatively speaking, than what they used to be in the past. So we're right up there with volume. We got good liquidity, lots of interest. We also have a record of longs in the futures contracts, but you need to keep in mind that's the managed money and not the commercials. The commercials are the bullion banks. The managed money is the hedge funds, otherwise known as speculative long. So there's a lot of hedge funds thinking we're going to take a run here, and we haven't been at this level since 2007. So that ties into the volume picture. The other thing we have on the daily, which that's the chart we're not looking at, we had a golden cross, which was the 50 EMA over the 200. Some people use the simple moving average. I like the exponential. But we crossed it on the daily. We haven't done that on the weekly. But when we get a 50 across the 200 on the weekly, watch out. We're going to get some serious price movement at that point. Don't know when that's going to come, but it's looking like we might get there pretty soon. And if you look to the far right, I've got that. It almost looks like a bullhorn, but don't confuse that with a megaphone pattern, which we had in early 2016. What we have now is an ascending broadening wedge, and we're fitting right in that pattern. We're tapping the top line and the bottom line at least 3 times. So it looks like, you know, we may bust out of that trend line, go up and tap that top side of the broadening ascending wedge, and then we're going to get a throwback, which has to do with the inverse head and shoulders. Because when you break through a head and shoulders neckline, it's more positive when you get a pullback after the breakout back to the neckline and then pivot back off of it and continue on the path higher. And as far as Fibonacci's, hey, all those numbers are in there. But this morning, with all that news that we spoke about, we've hit a high today. Let me pull up my chart. I got it live right here as we're talking. On the spot chart, international, we hit 12.96 and 5 cents. So we're pretty close to that 1300, and it's this peekaboo game that we're playing with this 2011 trend line, and it's just got to get over it and get done with it. And like I said, I think that's going to happen this time. Lastly, a couple of indicators down at the bottom. I got the DMI crossover on the weekly, but that ADX, which is the black line, hasn't come up from underneath yet and created that alligator tongue. But if I had the daily chart up, that's what's going on. So the daily chart's very powerful now. And the Stoke RSI, we got the positive crossover, and it's very positive on the daily as well. So that would take us into silver.
Steph, so I want to ask you about silver, and I want to also bring up Bitcoin and digital currencies. We're obviously seeing this massive bull market happen here in digital currencies. And, there's a little bit of a frustration, obviously, in the precious metals community because so much of what we're seeing happen in Bitcoin and Ethereum was what everyone thought was going to happen in gold and silver. And Ethereum in specific has been at the $7 to $10 range for a good amount of time, and now it's the $250 level, a move that many of us are expecting silver to do, to have that same sort of move, but we haven't seen it quite yet. But I want to get your thoughts on whether or not you think it's possible for gold and silver to have that sort of move, and or are we kind of stuck in this minimal upwards moving 5-10% moves at a time, or could we get into that moment where things really get crazy and exciting, hundreds of dollars and hundreds of percent in a very short period of time?
Absolutely. If we look at I did a post on Bitcoin actually over across the street, and the title of the post is Bitcoin Overextended and Plunged. High frequency trading algorithms driven repo and timestamp warnings. Now, if I compare that headline to gold or silver, the difference is that this is happening in Bitcoin, at least this run from just under 1,000 up getting close to 3,000 in a very short period of time. So it's not in a bubble in the long term. You know, I hate to use that term bubble, but it did get ahead of itself. And there are a lot of reasons for that. Strictly looking at the charts, if I compare what has happened in this very short time frame with Bitcoin, which continues because these moves are very violent. I mean, even today, I'm looking at the Bitfinex, and I like that one because it's got the most volume. It's out of Hong Kong. It's well known, a lot of liquidity. That hit just below 2,900 this morning, and we've already dropped. We've done a $250 drop between 9:30 this morning and 12:45 this afternoon. So very, very volatile. If you're in there trading it, that's one thing. If you're looking to purchase for core positions for the long term, you got to be patient. You got to wait for these pullbacks because there's going to be many, many, many of those. Now, gold and silver. I did a post on Across the Street most recently, and the title of that post is Gold to Break Out, Flip a Coin, Silver Still Lagging Behind. And in that post, there is a chart which I pulled out of my archives that is from January 2009 to August 10th, 2011. Now, remember, silver got close to that $50 mark several months before gold hit its high in 2011. So silver was leading the gold chart last time around. It could still do that on the big run this time around. Doesn't necessarily look like that, but who knows? But if you look at that chart, it took from January 2009 until midsummer, August of 2011, there was this channel which was like Cliff High is calling the Bitcoin the what did he call them? Shark teeth?
Oh yeah. It's some. I thought it was some sort of technical analysis term he was using.
Yeah, well, if you look at that gold chart, that's exactly what that looks like. You get this long, drawn-out accumulation phase, which is the primary bull phase, which launches you into a secular bull phase. So yes, we've already had it. And number two, we can have it again. But like I said, I think Bitcoin is a little bit ahead of itself. And if you want to jump in, you got to know what you're doing if you're going to trade it. You got to be glued to your screen and pay attention. And if you're looking for core positions, wait for the pullbacks because they're going to come. They're going to be vicious. But then the bounces higher are going to be just as powerful. So you need to know what you're doing if you're going to play in it.
Sure. Steph, interestingly enough, though, we can expect that if we do see a massive move in gold and silver, when it's in that very excitable, exuberant phase, too, right? I mean, if gold starts its move to 10,000 and it does it in a hurry, it's going to be very volatile getting in and out of gold, wouldn't you say?
That can change on a daily basis, but like I said, as far as time frames are concerned and the percentage of gain that we've seen in Bitcoin here happen in a matter of 2 months, really, this big move, whereas with gold and silver, it took a lot longer to build up to that point. So, you haven't missed the boat yet in Bitcoin. I wouldn't be too concerned.
Well, let's get over into the charts on silver here. A lot of excitement around silver, and I think... Man, so many of us feel like silver is just one of the most undervalued assets out there at the moment, and it's just waiting to have its moment. Let's get your thoughts on it.
Well, the chart looks like crap. Gold chart looks so much right. The gold chart looks so much better right now. But both are so underpriced as far as what their fair value should probably be. And if we look at this silver weekly chart, where should I start? Well, we got a trend line from 21.13 that did not exist in the middle of 2016, because when we put that high at 21.13 in 2016, that gave us a second point to draw the line from a high that we put in 2013 after the initial plunge down from 50. So that's where that trend line came from. Now, if we go back to 2015, I got an inverse head and shoulders line, neckline sitting there, and I extended it over to the right just a little bit thinner, so it hits the price point axis on the right. You know, somewhere between $17.50, $18 is a pigsty. There a lot goes on there, and it's been going on for a little bit over almost 3 years now. We got to get back over that $18 decisively, and then we have a secondary trend line that's drawn down from that 2016 high, which has a second point on it that just occurred this year, January, in the middle of April. Once we get through that, you got the 200-day moving average. Now, there's some other things going on here. Look, silver hasn't even gotten its mojo on the daily. It doesn't have a golden cross, the 50 over the 200. Nor has it done it on the weekly, whereas gold has already done it on the daily once, pulled back, and then now we're back above it. So silver is behind in so many respects, but when it moves, because the price is so much lower, the percentage gains can be so much larger, and it can be much more violent than a move in gold. So it can be exciting, but now is not the time. And we've talked about a specific number that I'm keeping an eye on, and I call it the number. And that's 2149, because you got to pull your charts back to March of 2008, before we had the financial crisis, and we put in a high of 21. I was in the 40s, I believe, but there's a Fibonacci number at 2149. So let's just say 2150, right, to keep it simple. And then if you go a little bit into the future, beyond that, when we bounced back up from the financial crisis and began to run up to 50, when it crossed that 2150 line, that's when we got that exponential move that we were just discussing in comparing Bitcoin, silver, and gold charts. So 2150 is an important number, and I'm not going to get too excited until we see that taken out decisively on volume, just like we want to see with the gold price take out that 2011 trend line. Now, down to the bottom on some of these other technical indicators, the DMI, we got a crossover, but we don't have the alligator tongue yet, so it's undecided, but it looks good. As long as gold keeps moving, silver is going to follow. Same thing goes with the Stochk RSI. We just got a crossover, but it's not as strong as either of them look currently on the daily chart. So, but the volume, look at that volume, how it has fallen off since the end of 2016. It's just really bad. I don't like that. But I got a feeling it's going to pick up if gold continues to move forward.
Sure. Yeah, and it really does need that momentum. I think people have been so scarred with the precious metals kind of going up and back down, up and back down. They're still not believing it yet. They're not fully convinced that it's going higher from here. So I guess just your final comments then, Steph, on gold and silver and how people can learn more about you. Obviously, you got your Twitter. And again, thanks for coming on the line with me today.
Hey, thanks for having me. Plan your trade your plan. You know, things could get a little crazy this summer. There's a lot going on geopolitically, economically. We got Bitcoin making its big move. Pay attention to what you're doing and don't get caught with the herd. Just put your emotions in check. Look at the charts if you're familiar with charts, or at least follow someone who does charts so you know what you're looking at, and make solid decisions, not based on your emotions.
All right, Steph. Well, hey, thanks so much for coming on the line. If you want to learn more about her, she's at Trader Stef on Twitter, and also you can read her work right here at crushthestreet.com. Thanks for coming on the line.
Hey, thanks for having me.